Good day, I'm Marius Cornelissen, Portfolio Manager at PSG Wealth Menlyn. It's time again for our quarterly update, so let's look at the events that moved the markets over the last few months. Well, we all know inflation has still remained relevant. That of course led to higher interest rates and of course a fear of a recession, not just in South Africa but globally. We've also seen Eskom being front and center of our minds. Over the last few months, however, we've moved away, from what we fear to be a total blackout looming to lower levels of load shedding, although the last day or so it has picked up again. One of the other main events over the last few months has of course been the whole story of ChatGPT and artificial intelligence, and we'll look later on how that also moved the markets. Well, first off, the US inflation rate is coming down. The US seems to be on the right path. And you'll see the blue line, of course, is the US inflation rate. Over the last year, that's moved down from over 8% to a level of just about 4%. On the same time, we've seen interest rates being increased by the US Federal Reserve. Now, they've moved quite a bit from levels of 2.5% a year ago to over 5% currently. Now, the expectation is that the Fed will probably increase interest rates at least once more to a level of around about 5.5%. Now, if that happens, some commentators feel that that might be a bit too far, as we can see that inflation is coming down and pressure seems to be easing. But even if they increase, it should be, if not one of the last increases in interest rates that we'll see from the US Federal Reserve. In South Africa, inflation has been a lot more sticky than in the US. There it's dropped quite a bit, but our inflation rate has stayed above 6% now for the last while, currently sitting at around about 6.3%. Now that is about to change, because over the next 2 months we'll see figures that on a monthly basis will come in significantly lower than the figures 12 months ago. As you'll see on this chart on the left hand side, 12 months ago those 2 months had month-on-month figures of 1.1% and 1.5%. Now if we assume that the month-on-month figure comes in at, let's say, 0.5%, and again at 0.5%, which is still highish, we'll see a drop over the next 2 months in the inflation rate down to around about 4.8 to the low 5% levels. That'll be right smack bang in the target range of the Reserve Bank. So the likelihood of the Reserve Bank increasing interest rates are becoming less. However, just because of the recent volatility in the rand, we might see one more increase by the Reserve Bank. That seems to be the case. Maybe 0.25% increase, also to run with the US Federal Reserve. However, after that, that should be it. Inflation will then settle at around about 4.5% to 5% for the foreseeable future if all things stay equal. And if that's the case, we'll probably see interest rates cuts coming through maybe early next year. Energy prices are still heading lower. Now, if one looks back at the price of TTF, that's European gas futures, as well as Brent crude oil, you'll see that over the last year both have dropped significantly. Brent crude oil now settling comfortably the last while under the $80 a barrel level, and it seems to be quite stable there, and gas prices are now a lot lower than they were before the invasion of Ukraine. So that is very good news, not just for local inflation, but also for global inflation as a whole. Inflation will cool further. Why? It's not just energy, it's food as well. I've spoken in the past quite a lot about the food prices that accelerated in 2021 and especially in 2022 as a result of disruptions. But it's come down a lot and the trend is still continuing. Now you'll also notice that looking back over the last 2 years, that the global food prices as measured by the United Nations, this is of course in US dollar terms, is now lower than it was 2 years ago. So we're seeing a bit of change coming in with food and with food inflation. Now of course we've still got local issues that's resulting in our food inflation being high and sticky, but also that will change in the next few months. Eskom, yes, over the last week or 2 or 3, we've moved away from chatting about a total blackout or the risk of that to us moving to lower levels of load shedding. Now, it's picked up in the last few days again, but there seems to be less breakdowns coming through, and the sheer amount of rooftop solar that's going on from businesses as well as normal household, that's having an impact at this stage. Now, for the first 3 months of this year alone, the imports of solar panels was enormous, and significantly more almost than any other period last year. We will easily exceed the imports of last year, and that will have a tremendous impact on the level of electricity generation by households as well as businesses, and which could well help us maybe get over the hump of load shedding early next year, as well as if Kuiberg and Kusile comes back online as they should. So the load shedding picture looking ahead over the next 12 months, not as dark as maybe it was a few months ago. Now that of course is fantastic news for the local economy as a whole, and it'll also just boost consumer sentiment, which has been lagging behind quite a bit into the future. Now, recession. We've all been talking about recessions and the likelihoods of recessions locally as well as offshore. But if we look at the global economy as a whole seems to be showing resilience. Last year, the global economy grew by around about 3.1%, and the OECD predicts an increase of 2.7% for 2023, and they expect it to increase to 2.9% in 2024. So the world as a whole seems to be quite resilient despite high interest rates in a lot of countries in the world. And we're seeing lots of other fluctuations and fears and war. The global economy as a whole is still growing. So as a whole, the fears of a global recession seems to be overdone at this point in time. However, we might still see some countries going through a recessionary period. Now the US, everybody talks about them and say if they slip into a recession, markets will drop. But as you can see on this chart, the US economy is extremely resilient. The growth is under pressure if you look at it on a year-on-year basis, and a recession is possible, albeit it will, if it happens, be a mild one. There's still significant strength in the US labor market, which is one of the reasons why the Fed seems to be keen on increasing interest rates at least once more. But as a whole, the US seems to be resilient and not that bad. So let's just dig down into a couple of factors of why that could be. Everybody keeps predicting the recession, but it seems to be pushed down the line the whole time. Now, if one looks at consumer confidence was extremely high before COVID hit. Then it dropped, and then, of course, because of lots of other factors, including the war in the Ukraine and the global supply chain crisis, we saw it drop down to quite low levels. But subsequently, in the last few months, we've seen it picking up again. So the consumer in the US seems to be quite resilient, and their balance sheets of the normal household is a lot healthier than it was 5, 6, 7, or even 10 years ago. So they are more resilient because that they can weather the storm a lot better than they could in the past. US house prices is also one of the interesting things. If you go and look at the Case-Shiller home price index and you look at the month-on-month basis, I mean, home prices in the US grew significantly over the last 10 years or so. We saw after COVID hit, it increased even further because interest rates were so low and people really only had certain places to spend their money, and a lot of people were working from home. We saw the demand for property really going up. So property prices went up, up, up and beyond. And then of course the Fed started increasing interest rates last year. What happened? High interest rates, well, that usually leads to a drop in home prices. And that's what we can see on this chart. It went backwards for quite a few months. But strangely enough, over the last 2-3 months, home prices have been increasing again. And that runs together with the better consumer confidence in the US. So it seems that on the floor level of the US economy, consumers are feeling okay about everything that's happening. They feel that the recession, if it hits, will be mild. They feel that we're getting close to the peak of the interest rate cycle. So we're seeing a lot of resilience and a lot of underlying strength in the US economy. And that's what's helping them skirt the recession at this moment in time. Spoke about artificial intelligence, and it seems that over the last few months, the whole AI thing has really sparked a tech rally. Now, last year, the Nasdaq index was a terrible performer in terms of global markets. The Nasdaq lost almost a third of its value in 2022, and everybody said, well, tech is dead. High interest rates are terrible for tech companies. Valuations were strained, they were just way too high. And everybody said, no, 2023 will probably be a repeat of this, and tech shares will continue to underperform, especially as long as interest rates are high. Well, conventional wisdom can sometimes be wrong. Since the start of this year, the Nasdaq has increased by almost 32%, and a lot of that has been the spark because of artificial intelligence. There's renewed interest in the whole sector at this stage, and it just shows you again, just when you think a certain section of the market is under pressure, it sometimes, because of news flow, turns around and then becomes a good performer again. So, close to the end, what keeps me awake at night? Well, still the war in Ukraine and potential conflict between China and Taiwan. That can always have an impact on the markets going forward. The big fear at this stage, as we're seeing inflation cooling down now, is of course what we've been talking about for the last few months, that global central banks might overshoot in terms of interest rate hikes. Now, if one listens to the language of the Fed, the European Central Bank, as well as the South African Reserve Bank, they are keeping a keen eye on it, and at this moment in time it seems like they've got it under control and they won't overshoot in terms of interest rate hikes, but still that remains a fear. Always there's the worry that if there's a recession it could be deeper and longer, but like I've pointed out, it seems that the US specifically is more resilient at this stage than what a lot of people thought it would be. Looking locally, corruption and state capture, well, it's still front and center of the news flow at this stage. Eskom, of course, still a worry, but especially getting worse and worse, the water situation. And with water shedding in a certain sense, also in Joburg, with Rand Water having to repair infrastructure, it's becoming a reality, and I think a lot of people are looking at that closely. Also, again, local political instability. With some of the coalition governments failing, they're going to need to have a long, hard look at how to make it work. What gives me hope? Well, there are opportunities given the weak markets. We always know that, and especially locally. The local markets seem to be cheap at this stage. There's a lot of value in the local markets, and it seems to be quite a bit of upside available going forward. The rand could be slightly stronger. I mean, as we go along and the US interest rate hikes stop and then they start cutting it eventually, we could well, in terms of that, see the dollar losing a bit of its luster, and currencies like the rand could strengthen a bit. So that'll also have a positive impact. We could see lower or stable petrol prices, especially if the rand strengthens a bit. Brent crude oil seems to be under control, so a bit of a stronger rand will have a big impact. Food prices seem to be becoming more stable as well. Stronger rand will also help in terms of that. Inflation in general, globally as well as locally, is set to cool even further. So that'll help with the interest rates and potential cuts coming through early or middle of 2024. Now, as we've said in the past, markets usually react swiftly to lower interest rates, and that'll be quite good, especially for the JSE. But at the end of the day, as I've said about the Nasdaq, a year ago people were busy writing it off. Now this year it's a fantastic performer. We've always got to be realistic. We've always got to make sure we diversify. Have a good day.